Hi everyone, a very good evening. You're watching The Money Show on ET now. I'm Veena Kapasi. This is the show where we get you all the latest news, trends and everything that you need to know about long-term wealth creation and of course checking in on your personal finances, the do's, the don'ts and whether of course your investment portfolio is aligned with your financial goals. Well, if it sounds like too much, guess what? We of course answer your questions and queries as well. So if you have any pointed questions with respect to personal finance, financial planning, your investment portfolio, you can write into us on the Money Show at etnow.tv. Moreover, if you have any topics that you would like us to take forward on the show, your feedback is always welcome. The email address remains the same, themoneyshow@etnow.tv. So here's what we have lined up on today's episode of the show. First up, mutual funds, their returns, their performance. How has it been in the last 3 years, 5 years, 7 years? And let's pitch that against another product, quite similar, but still not the same. That's Portfolio Management Scheme or PMS. How do the two differ? Is it that PMS is mostly suited only for the high net worth or HNIs, investors as we call them? What is the suitability of both of these products? What is the transparency of both of these products? And most importantly, of course, what's the return that both these products have given is what we'll be discussing on today's episode of The Money Show. So if you have any questions on the concept of PMS, like I always say, write in on The Money Show at etnow.tv. Secondly, we'll be talking about a job loss insurance. That's right, folks. If you have lost your job, or even if, let's say, you're self-employed, you have a little workshop or a business of your own which looks like it's going down under, an insurance product is available for the ensuing loss of income. That's what we'll be discussing with Policy Bazaar later on the show. And finally, in our Spend with TMS segment, we know what's been happening with HDFC Bank, with SBI. Your transactions may have had difficulty going through at a certain point of time if you've been using either of these banking channels. So what are the repercussions of the same? What has the RBI done to ensure that you're able to make a safe and secure payment? That's what we'll be talking about. We'll also be getting you a gist of how you can go about choosing a safe and secure payment method as well as credit card for yourself. So action-packed day on The Money Show. Without any further ado, let's kickstart and bring on board our very first guest. Nimish Shah, CIO for Listed Investments with Waterfield Advisors, now joins us. Nimish, much appreciate you taking out time today for The Money Show. Thank you so much for joining in. So Nimish, to start with, mutual funds, for those individuals who are investing in equity markets for the first time, it's a great port of call, and it's usually the first port of call for a lot of retail investors. But I guess the last 3 years especially, what we've seen in terms of mutual funds returns may have disillusioned some investors. Today as well, in fact, for the last couple of months, as the market has been going higher, it looks like a lot of mutual fund investors want to book some profits. They're redeeming some of their mutual funds. Not sure, of course, if coincidentally, of course, their goals as well are close by, in which case it's great. But I think it seems to be more of the view that, okay, markets are high, let's just take some money off the table. So firstly, what do you make of what we've been witnessing in mutual funds in these last couple of years? Let's get an initial comment from you on that.
So if you look at the mutual funds in terms of the the outflows, definitely it is kind of showing constant outflows for the last few months. But on the flip side of it, the SIPs have not dropped. So from a high of about 8,500 to 8,600, they are currently ranging at about 7,800. So SIPs are definitely the saving grace. But like what you rightly mentioned, it is definitely in terms of the markets seeing the all-time highs. That is what is making people probably book profits, and also from the point of view of requirement of money because of the COVID disturbances is something could be a combination of both, where we have seen withdrawals from mutual funds happening.
So what about the returns bit? If you would like to comment on that, especially if we have to compare it with the benchmarks. So large caps, small caps, mid caps, how have those category of funds done versus the benchmark? Nimish? Okay. Just a little bit of technical problem over there, but yeah, the idea behind this discussion is essentially to understand what's going on in mutual funds, and what sort of an option is PMS, the suitability as well of the same, and yeah, like Nimish mentioned, that may have seen a bit of tough times as such, but yeah, Nimish, I was talking to you about the returns. We have seen outflows, of course, but let's also talk about returns, especially in the last 3 to 4 odd years. How would you look at it, and would you, stress too much about it, especially because, personal finance experts, of course, say that, look, when you are investing in equity mutual funds, your time horizon cannot be 3 or 4 years, it has to be longer.
Right. So it's a very valid point that if you're looking at a longer term horizon, definitely one needs to be patient enough to ride out the uncertainties which we are witnessing in the market right now. These are clearly unprecedented times. And if you look at the performance with a longer term perspective, yes, funds are outperforming. But again, the category wise difference is there. So, for example, it is difficult now to get overperformance in large cap funds. But mid cap and small cap or multi cap funds are still seeing outperformance with a longer term perspective. So yeah, if your horizon, which should be more than 3 to 5 years, definitely staying invested makes a lot of sense rather than just booking profit, because in the short term, in the last 3 months, 6 months, you're not seeing profits coming in.
Okay, so you don't, essentially, even a mutual fund is not supposed to be a product where really, you look at the equity markets, you see it's rallying, and then you consider booking out, right? That's really not the purpose for which a mutual fund is designed. A mutual fund is, of course, designed to look at things from a more longer term perspective. So it's important to understand that as well. Now, Nimish, how does a PMS essentially compare, or rather, actually, before we go about comparing, let's first talk a bit about a PMS. What does it do? How similar is it as such with mutual funds compared to mutual funds, rather?
So PMS, is more from the point of view that the entry point itself is different compared to what you have in a mutual fund. Therefore, this is more oriented towards slightly more discerning investors, where they have more knowledge about the markets compared to what when they're investing smaller amounts in a mutual fund. Having said that, PMS strategies are are ideally also more in terms of focused in nature. So the fund manager's past experience, which has been in a particular sector or a particular segment of or type of managing the fund, that is what kind of plays in. So there is a fund manager who kind of specializes more in value stocks. There is a fund manager who specializes more in mid and small cap stocks. And there is a fund manager who kind of specializes more in multi-cap stocks. So choosing the right fund manager becomes very important when you're investing in a PMS compared to standardization, which is available in mutual funds. That standardization is not available in PMS. So one has to be kind of doing more research, more study before putting money into PMSs as such.
So, in terms of suitability, would you say that when an investor does invest in a PMS, he should have a little more of financial know-how as opposed to maybe a mutual fund investor?
Yeah, so that is what is known as the knowledge and experience. So, from the K&E perspective, as we call it, the investor should have invested into stocks, direct stocks, or into PMS schemes earlier, or he should be having the appetite to kind of fathom the volatility which can be higher in a mutual in a PMS rather than a mutual fund, because PMS will tend to kind of focus on a few stocks or on a particular theme or on a particular way the markets are playing out.
All right. So maybe a bit of. So would you say then that maybe an investor, it's better if an investor spends a little time in mutual funds to start with, learns how it works, and then maybe move on to a PMS? Would you advise that?
Yes, it can be a good stepping stone. So once you are comfortable within mutual funds, then you can go on to PMS, and especially if you have experience investing into direct stocks, then PMS can be an option where you have one more fund manager managing your stocks per se.
Okay, so PMS could be a good option, for retail investors. But let's understand a little more from the risk perspective and thus consequently from a suitability perspective as well. Let's say if somebody, or rather let's put it this way, a portfolio management scheme inherently versus a mutual fund, does it carry, and let's assume we are comparing the same kind, in terms of the category of mutual fund or PMS, how would you describe the inherent risk of a PMS versus that of a mutual fund? And let's assume a large cap mutual fund.
Sure. So great kind of way of comparing. So if you look at any large cap mutual fund, typically it will have anywhere between 30 to 50 stocks, which are underlying stocks as such. And if you look at a PMS, which is there on the large cap side, there are PMSs which have as small as about 4 to 5 stocks, and there are PMSs which have almost about 15 to 20 or 25 stocks at the maximum. So it's a much more concentrated strategy that one is getting into, and therefore the risk of a particular stock or a particular sector not performing is high when you are investing into a PMS. But on the flip side of it, there can be benefits in case the investment which has been made, which is more of a fundamental investment with a longer term perspective, is something which plays out well for the fund manager. So I would say that if you have a 2 to 3 year horizon, a mutual fund is a better option. But you have a 3 year or 5 year plus horizon, then and if you have the risk appetite to fathom that volatility, then definitely PMS should be some part of your portfolio.
Okay. Now let's talk about returns. We spoke about suitability, we spoke about risks. At the end of the day, of course, an investor also wants to know that when he or she is taking a certain amount of risk, maybe even if it's more, in a PMS, if they're getting the return, investors would be happy. Have we seen that? And let's pitch, the returns of a PMS versus a mutual fund, the factors at play.
So if you look at the history and the volatility of PMS returns versus mutual funds, there was a distinct period of time when mutual funds were outperforming the portfolio managers, and now is a distinct time where portfolio managers are outperforming the mutual fund managers to a large extent. So this is a cycle, and I would recommend that an investor, once he knows his investment philosophy, especially in terms of understanding the underlying investments which are being made, whether it is large cap, mid cap, or small cap, and within that, what is the liquidity profile, what is the volatility which is attached to it, what is the fund manager's expectations as far as the holding period is concerned. So there are PMS managers who very clearly say that if you don't have a horizon of less than 3 years, if you have a horizon of less than 3 years or 5 years, then our product is not the one for you. So that suitability becomes very important. So as a risk profiling, I may be an aggressive investor, but within that aggressive investor, if my liquidity investor requirement is different compared to another aggressive investor, then I have to weigh whether I should be investing into a PMS or into a mutual fund. But yes, PMS, if you are convinced about the fund management style and the philosophy, it definitely merits a place in your portfolio.
Okay, that's a very interesting take, actually. It's more than the returns. You have to look at things like liquidity, etc., as well. And in fact, I was seeing a very interesting report about the kind of transparency as well with a mutual fund, with the PMS as well. Now, we know mutual funds, of course, they give their monthly fact sheets, which is put on the website very soon. And I think from January onwards, AMFI has, or rather SEBI actually, has asked for even more disclosure, risk brackets, so on and so forth. So we know about to what extent is there disclosure, transparency about portfolio in a mutual fund. What is the communication that PMS managers essentially give to PMS investors? Pardon me.
So the transparency is kind of relatively lower compared to mutual funds on two counts. One is in terms of the regulatory requirement, which the PMS industry relatively smaller in size and nascent compared to mutual fund, which is kind of been through a good maturity cycle. So we have a lot of standardization also, which is possible in mutual funds, which is not possible to a large extent in PMS because of the different philosophies being followed by the different fund managers. So, take for example, an investor who has come into PMS 2 years back versus the investor who has come into the same PMS, say 1 month back, is likely to have a different portfolio. Right? Because the stocks invested 2 years back may not be, the fund manager may not invest in the same stock in the same proportion currently. So to that extent, it becomes very difficult to compare. But yes, transparency is available for PMS investors. So once they invest, most of the PMS managers now have online portal where every day the investors can go and check their portfolios. And of course, as and when they make changes, that also is kind of disclosed to clients on a regular basis. So on a monthly basis, definitely they disclose their portfolio. But if you are an investor, then definitely it is available online also with most of the PMS managers.
Nimish, this is a point we've not talked about so far, and that is with respect to costs. What's the cost structure like for mutual funds? What's the cost structure like for PMS? And, from what I understand, there was also in March earlier, there were certain rules introduced by SEBI with respect to PMS, with respect to the cost structure of PMS. So if you could just differentiate between the two.
Sure. So just like in mutual funds, you have a direct scheme option where the investors can directly go and invest at a different fee structure than what is on a normal distributor-led fee structure. In the PMS, also SEBI has mandated that PMS houses should kind of have two fee structures: one for direct investors and one for distributor-led investments. However, as I mentioned earlier, PMS industry being in a different maturity cycle. As of now, all the large PMSs especially have seen their AUMs grow on back of distributor-led AUMs coming into their PMS, AMCs. And to that extent, the fee structure is different, compared to what the mutual funds are offering in terms of both direct schemes and distributor-led scheme. So the difference, for example, on an equity large cap fund in a PMS versus the difference between a large cap mutual fund may not be the same. It may be higher difference in a mutual fund compared to a PMS scheme as such, purely from the point of view that there is a lot of specialization which happens on the PMS, and there is a lot of a cost involved in a direct investor for a PMS house. So unless it is through an advisor, where the PMS investor has an advantage of looking over various PMS options available. Otherwise, direct investments can be taxing as far as managing the same by PMS managers is concerned.
All right. So let's talk about customization as well. Of course, a mutual fund offering, it's given to lakhs of investors, and it's a standard product. Some PMS also do offer customized solutions. But again, would you advocate that, as an individual, I should not go for such products until I myself have some exposure in direct share investing, a little sense on how the equity markets work?
So if you are not giving the mandate to the fund manager on the PMS side to manage, then I would not recommend the PMS route. Under the PMS, there is also another option, which is the non-discretionary portfolio management scheme, where if the provider has a NDPMS option available for clients, then one can have their own discretion whether to buy or not. If you are appointing a portfolio manager and paying him a fee, the idea is that you are relying on his expertise to give you and generate the returns which you are expecting from the underlying portfolio. Now, if you are going to take away or have your own inputs regarding what stocks he can buy and what he cannot buy, then I think you are defeating the purpose for which you are giving the money to the portfolio manager. Having said that, the PMS managers have the option of not investing into a particular stock or a particular a sector if there is any conflict of interest by the investor. So, for example, if I am employee of a IT company, and therefore the IT company may restrict me from investing into that particular company shares. So I can have a negative list of stocks which I don't want the PMS manager to invest. But beyond that, I would not recommend that investments in PMS are made subject to your own discretion. It should be left to the fund manager.
Well, that's his expertise, right? He's got all of this wealth of knowledge, wealth of experience in directly investing large sums of money in the equity market. So his specialty is in that, his expertise is in that, and I suppose that's a very logical reason why Nimish would advocate that. Look, don't taxi drive, if we could call it that, the PMS manager too much. Right. You need to leave it to him. Of course, if there are certain laws that restrict you from buying a certain sector or buying a certain stock, just like the example that Nimish give, then you can just give a negative list of sorts, and the manager will avoid those stocks. But otherwise, it's best to leave the expertise, or rather rely on the expertise of the PMS fund manager. You are paying him or her the high fee after all, so might as well make use of it. Nimish, is there any minimum amount that I would need to invest to kickstart my PMS journey?
So as per regulations, the minimum amount is 50 lakhs. But depending on the fund manager, sometimes the fund manager may have a higher threshold for entry. But otherwise, regulatorily, it is 50 lakhs.
Okay, so there is a minimum amount any which way is required of almost 50 lakh rupees. And mind you, like Nimish said, on the liquidity front, it may not be as easily liquidated as a mutual fund. A mutual fund, you simply can just press the redeem button, but it's not that tough for a PMS, and that's a very, very important point to consider as well. And that's perhaps the reason why SEBI has said that, look, the minimum investment is 50 lakh rupees, because HNIs of course do have a higher risk taking ability as well. So that explains why there is maybe a little more risk associated with a PMS, with a portfolio management scheme. You heard out Nimish on the return bit. You heard out Nimish, of course, on the suitability aspect of it as well. For those individuals who may not have too much of knowledge on how the stock market at a large works, or how anything in fact in equity markets work, it's best you start off with a mutual fund. It's highly regulated. SEBI watches over it very, very carefully. You have all of these frequent disclosures as well, all of it in the interest of the investor. So it's very transparent. You can get out of it easily in case of an emergency, in case of anything. And let's not forget, it's a standardized product, like I mentioned. But of course, once you maybe gain a little more knowledge in direct investing, in the share markets, etc., then you can of course move to portfolio management scheme, which can be customized as well to your needs. However you want, if you want to avoid a certain sector, or if there's a certain theme you want to play, it can be customized. But of course, Nimish mentions that as far as possible, try to rely on the expertise of the PMS fund manager. Okay, well, on that note, Nimish, many, many thanks for joining us today on ET Now, and guiding our viewers on this entire bit on mutual funds versus PMS. Yes, you may not be very happy with the returns given by a mutual fund, but remember that your aim is to invest for a certain goal, for a long-term time horizon, not for 2 years, not for 3 years, especially when it is equity mutual funds. So yes, you may have had a bad lull for 3 years, but again, if your goal is nowhere close, then it really is not something that should perturb you much. Well, ladies and gentlemen, we'll take a very short break on the show, and like I always say, if you guys want to catch up on this interview again, you can log on to ET Now's YouTube channel and find this interview with Nimish Shah of Waterfield Advisors on the Money Show, or rather in the Money Show playlist. For now, we'll take a very short break, but when we return, we'll be talking about a very interesting insurance policy, one that gives you a replacement for the income you may lose if you lose your job.